Today's Talk About It Tuesday question is, I'm hearing so much about a looming recession. What should we do with cash in the bank? I'm not getting large interest anyway. Should we look to purchase gold or silver? Okay, so let's just talk about this recession thing real quick. We are absolutely, if we're not already in a recession, we are heading into a recession, as is Europe, as is China, and whoever goes down first will bring the others down. So it is not only looming, it is inevitable. It is going to happen if it already hasn't started. So if you already understand that we're going in a recession or we're in a recession and the ripple effects will be job losses, devaluation of assets, we'll start seeing, everything that we've experienced in every other recession, a very strong contraction of the economy. If you know that, then what do? You should be preparing for it now. You don't wait until we're in the depth of the recession to try to prepare for it, because usually it's too late. So the question is, what do we do with this cash in the bank? What is happening currently that is helping to drive us in a recession is we were in an extreme growth period because the market was flooded with cash. When the market is flooded with cash and very low interest rates, so people are borrowing, you have massive buying. When you have massive buying, the economy grows too fast, too rapidly, and you have super high inflation is what we're experiencing. So to counteract that, the Federal Reserve raises interest rates. All the central banks around the world, they're all raising their interest rates to curb borrowing, to curb expansion, to curb spending, to try to bring the prices down. But inevitably, what does that do? When you get a contraction, you end up in a recession. So right now, and I have to qualify this, I am never a fan of having a lot of money in the bank, whether the economy is great or not. But right now is not a terrible time to have money in the bank, because interest rates had to be raised and are continuing to be raised in order to slow the economy down. So higher interest rates benefits savers. So if you're going to have money in the bank, and again, I don't think you should have much money in the bank, you should go on bankrate.com or nerdwallet.com and look for a high interest savings or money market account. Right now, the top ones that I saw are paying over 3%, which is, although it's not keeping up with the inflation rate, is a great return for a savings account. I think something that is more in line, if you don't need the money right away, if it's not an emergency fund, if you can forestall, pulling it out for like 5 years, the Series I savings bond, which keeps up with inflation, and at the time of this recording is paying 9.62%, which is on par or a little higher, slightly higher than what the inflation rate is currently. So if you're going to keep money in the bank, again, which I'm never a fan of, having more than you need for an emergency, and really sometimes I think we overestimate what an emergency is. Losing your job is not an emergency. That's a crisis, right? That's a whole different ballgame. Emergencies come up where you need cash really quickly, whether it's a medical copay, a car repair, or so. That's an emergency. It happens. And most emergencies are $1,000 or less. Sometimes, if your transmission, $2,500, $3,000. So you shouldn't really have more than that in a savings account for an emergency. Everything else should be invested. So again, if you're going to have it in the savings, I think high interest savings or money market. If you can hold on to it a little longer, then I suggest the Series I bond. And so basically, don't go into gold and silver, because gold and silver are not acting like they traditionally have in terms of being a hedge against inflation. If you look at the 6-month and 1-year returns on gold and silver, they're both negative, right? So, I think gold and silver as a store of wealth is a fading thing. I've talked about it in other videos. I've never been a fan of that anyway. but I think it's really on the decline. So I would not run and put money in gold and silver. For short term, like I said, Series I bond, money market account, high interest savings account, usually online account, and the rest I would use to scoop up the assets that will inevitably continue to decline. So if we look at stock prices, not stock values, and I think we make a mistake in misunderstanding the difference between price and value. There are some good value companies that are trading at a super low price right now because of the conditions of the market, not that the company is not good. So I would use that cash to grab up some good quality companies that are on sale right now. I'll probably stay away from the index funds because they're in decline. But there are some really good companies out there, some consumer staples. I would stay away from the tech companies, just energy companies. All these types of companies are going to do well for a while. Things in the medical industry are going to do well for a while, and they're all on sale. So I would not buy gold. I would not buy silver. I would not leave it in a traditional savings account, high interest accounts, fixed assets like Series I bond, and I would hold some of that cash in reserve because as prices continue to drop, you can just swoop in and buy good quality assets at a discount. So when the economy comes back up, you've already made your money. So great question. Prepare now. Don't wait. The time is now. Start shifting things around. I'd love to hear your comments. Keep the questions coming, and I'll see you next Tuesday.